We are on page 33, about the middle of the page, just a little bit above the middle of the page, talking about FINRA regulations and other SRO regulations. And we're starting out on conduct rules. And the reason I wanted to break on the last video and cover this on this video with a starting point is that there are four different sets of rules that we'll need to be familiar with, and I like to give that big picture view and give us a little bit of a way to remember what's covered by what, in case you need to tell where such and so a regulation is found, or what that set of regulations covers. So we've got the conduct rules, the uniform practice codes, code of procedure, and the code of arbitration. First of all, the conduct rules, they govern how we conduct ourselves with members of the public. So principles of fair dealing and what have you, they're all found in the conduct rules, because that's the way we conduct ourselves in public. The Uniform Practice Code, I'm going to go ahead and underline conduct because that's the key right there. Uniform Practice Code, that's how we practice among ourselves. So how do we treat other members? Treating the public in the first one, treating other members in the second set, and then the Code of Procedure, that's the COP, that's the cop. When do we call a cop? When there's somebody's breaking the law, right? So if there's been a rules violation, ran out of room. There we go. If there's been a rules violation, those procedures will be covered in the Code of Procedure, the COP, the COP. But now I have to kind of stretch for this one, okay? You know there's an International Talk Like a Pirate Day? There really is, okay? So, I mean, do you know why pirates talk to each other the way they do? Just because of who they are. So, yeah, there we go. And so, we've got the Code of Arbitration. We'll talk like a pirate, okay? And the Code of Arbitration is where we arbitrarily come up with someone who's going to independently decide between two parties when the two parties get into an argument. Oh, that's a stretch for that one, isn't it? But anyway, really, these two are kind of hard to keep separate. So if we have an argument, then it's going to go to arbitration, if at all possible, and somebody's going to arbitrarily decide who gets what. It's going to be a money type situation. Like I said, this is a rules violation, but this is a money issue. So that's one of the ways that we can keep track of what covers what. The way we conduct ourselves with the public, the way we practice among ourselves as members, and then the COP, Code of Procedure, we call the cops when there's a rules violation. And then the Code of Arbitration, when there's a money argument that's going on and we need someone to decide who gets what. All right, so with that in mind, let's go into some of the particulars. And the conduct rules starts out with advertising and sales literature regulations. First of all, we have to know what it is, okay? Advertising is the broad net, okay? We don't really control who sees it. I mean, think about a sign that you put on the side of the bus. Who sees that sign? Well, where does the bus go? Who lives there? Who works there? Who's driving along that street? I can't control that. Newspaper ad. Who controls it? I can't control who sees that. But the thing is, if we take our advertising and it generates leads, A-D-V-E-R, that's a T, isn't it? Man, I tell you what, my spelling is just really hurting today. It generates leads for us, then we're going to send something to those people that has a lot more detail. That's going to be sales literature. So it's kind of a target, and those people, by expressing an interest or by somehow or another, we know where they are, we know who they are, then that's going to be sales literature. Generic advertising can have no specific recommendations. Mutual funds will do this. You'll see it on TV. I mean, our research staff is really cool. They do a great job. You know, what does it mean when this goes on in that part of the world and whatever? Yeah, that's just generic advertising is what it is. Do they make any specific, you know, you need to buy this fund? No, because they don't know if that fund is appropriate to the people who are watching. Who's watching that ad? It could be young pups or old guys. I mean, you know, it could be anybody. So that's generic advertising. Sales literature, on the other hand, is targeted. We know where it's going, we know who it's going to, we can control it. So we can actually make a recommendation in sales literature because we know who's going to get it. And we know that suitability information. Reprints of magazine or newspaper articles. Think about it, okay? We see a good magazine, newspaper article. So what's the first thing you do? You get your principals okay to proceed from there. If the principal doesn't say okay, you're shut down. But if your principal says okay, then you take it down to office supply, say, again, you run me 100 copies of this. And what do? You don't get a helicopter and bomb the neighborhood with them. That's littering, okay? No, you take them and you address out envelopes and you put stamps on them and you send them to regular, just specific individuals. That's sales literature. You know where it's going. All right, so that's, like I say, sales literature. Magazine, newspaper articles, approved by the principal is required, and there is a retention requirement subject to spot checking. Typically, your records retention is going to be 3 years. The first 2 years has to be readily available, so that when an auditor comes in, where is this stuff? Boom, it's right here. You can go to it. All right, but you have to retain that. And then you have to file advertising and sales literature with FINRA within 10 business days of its first use. So that means that, now the regulation is more detailed than that, but we're not here to prepare for an audit. We're here to take the Series 6 exam, okay? And so if I have some advertising, let's say, then I can use it today, and 2 weeks from now is the deadline for me to get it into FINRA. All right, if today is the day that I first use it. Like I say, the whole regulation is a lot longer than that. Don't worry about it. It's something, unless you're going to be a compliance officer or set up your own broker-dealer firm, it's going to be of no concern. All right, so mutual fund or omitting prospectuses or mutual fund tombstone ads. Now, this is something that we kind of put off way back when, because we talked about tombstone ads with new issues of corporate securities, and then we said mutual fund tombstone ads, they're totally different, and they are, okay? Because remember that you cannot sell, advertise, recommend or solicit new issues that are in registration. But mutual funds are always in registration because mutual funds only deal in new stuff. You got to tweak the rules. So you've got this provision that's called an omitting prospectus under SEC Rule 482 that says that as long as we can advertise mutual funds, but essentially everything has to be from the prospectus. Now, not absolutely everything. So like, for instance, if you have a fund that's going to benefit from current economic conditions, you can say this is something that is poised to benefit from an expanding / contracting economy. Okay, that's okay. But like I say, typically everything else has to be found in the prospectus. So it's requirements for performance reporting. It's standardized. You got to give 1, 5, or 10 years. Only been in business 8. Well, 1, 5 in life of fund. Okay. I have month-end updates that have to be available by phone. And I have to give like a toll-free number where people, if they're really, really interested in what happened as of the end of this month or last month, I guess it would be, then they can call in and get those numbers within a reasonable period of time from the end of the month. It can contain, like we said, information not in the prospectus, like current economic conditions, but it cannot provide the opportunity to invest. What it does provide, and you've seen it, okay? Because you've seen ads that say, this is not an offer to sell or a solicitation of an offer to buy. Such an offer is made only by the prospectus. Contact your financial consultant to get a prospectus. The prospectus contains all fees, charges, etc. You've seen it. The reason they have that in there is that that's one of the provisions of the SEC Rule 482. And then standards in dealing with the public in general: fair, reasonable, truthful, not misleading, in good taste, things like that, okay? But specifically, claims and opinions, okay, must be based on fact. Well, I'm a graduate of the University of Tulsa. I think the University of Tulsa is going to win the NCAA tournament. There would be more precisely stated. I wish that they would, okay? But as it stands right now, one of these days they might, okay? I just don't know which one. Okay, but like I said, just make sure that you've got some fact to base it on. Identification of sources, you've got to do that. You can't say, this group is, there are going to be hundreds of takeovers in this particular group, this industrial group. You need to be here in this. Says who? Identify who did the analysis. It's given in the proper context. The most truthful statement taken out of context. Just ask a politician. That happens all the time in politics. Offers of free services have to be free. If you see something like if you, when you, because you, in exchange for, no, that's not free. Free is just, there you go. And I really appreciate you taking this. That's free. Okay? No strings attached. Disclosure of paid testimonials. I don't care what it is you're selling. If you pay me enough, I like it. I really do. Okay? So, if you're using my testimonial, and it's a paid testimonial, what is fair, reasonable to disclose that you're paying me? And then unusual economic or financial conditions. Again, we had, back in the 80s, we had excruciatingly high interest rates. And then little by little, they started to come down. And by the time we got to the end of the 80s, the mid-90s, they'd come down tremendous amount. Bond funds did just huge returns during that time. Can they do that kind of return today? Probably not, because that's an unusual circumstance. You can't say, you couldn't say in 1995, well, look at what we did back in the 80s. Well, we can do that going forward. No, there wasn't a reasonable expectation of doing that. Different circumstances. Exaggerated or, past performance does not indicate future results. You've heard it a million times. You'll get so tired of it, but you've got to say it every time. Okay, it's just a standard line because it's very true. Just because we did something in the past doesn't mean we can recreate that. Exaggerated or unsubstantiated claims are prohibited. Those just sound bad. And then comparisons to other investment products, they're prohibited because, my go-go growth fund, it just stomps the heck out of a treasury bill. But wait a minute, within a year, I know I'm going to get my money back on the treasury bill. It's a whole different breed of cat, all right? On this go-go growth fund, I might lose everything I've got in it. So don't make those kind of comparisons. And no assurance of gain, no assurance of avoidance of loss. One is as bad as the other. You can't do that. Just don't make those statements. Suitability rules. We talked about the prerequisites to investing, I think twice already. So rather than rehash it here, I'm going to say that the first thing is cash reserves. But look at all those factors. Excessive trading or churning is prohibited. And that can be based on either the number of trades in an account or the size of the trade that's inappropriate to the customer's means and their assets. So like I say, just make sure that the number and size are within the customer's objectives and their ability. Now, what is the right number? You can't answer that. Okay? With mutual funds, it's much easier because mutual funds are designed to be long-term investments. And so it's going to be fairly low. All right? If you're moving from fund family to fund family, that possibly could be interpreted as churning. Because why? Because you're subjecting your customer to a new set of sales charges every time that you make those switches. Okay? If you switch inside a fund family, then you need to look more at the taxes. Okay? This is appropriate given the customer's tax situation, given their investment objectives, given their willingness to move from fund to fund, from sector to sector, what have you. Okay? But it all depends, all right, and on the customer and what their means are, what their goals are, and what their risk tolerances are. Let's see then, reasonable charges for clerical or custodial services are allowed. You can do that. Probably the prime example of this is the major brokerage firms that have the central asset accounts, that have the integrated money market fund, and the check writing privileges and automatic sweeps to the money market fund, and they charge you a certain, a nominal amount per year, and they say that it's for all those it's not, it's the clerical stuff that they're charging you for collecting those dividends, for doing the safekeeping, what have you. But it's a reasonable charge. It's okay. It's disclosed to the customer as it needs to be, and and you can in fact include a commission for the liquidation of customers' mutual fund shares. Customer comes in, brings you a certificate, and says, "I need you to cut me a check at the end." Are you going to do that for free? Well, you can, but you don't have to. You can charge a reasonable amount, disclose it up front. Don't do anything in secret. Just anything in secret is going to be bad. Put everything up on top of the table. All right, so, and then communication with the public. You know what correspondence is. Okay, correspondence is something that's sent to 25 or fewer retail investors in a 30-day period. All right, so that's just basically a letter. That does include emails. All right. There are certain rules that you don't have to get into here. If you're testing to be a principal, you need to know. But basically, there are provisions for typically approval after the fact. Okay. If certain provisions are not in place, the principal has to approve beforehand. And then similar supervision is required for websites, public appearances, what have you. Anytime that you have any contact with the public, then you're going to have a principal look at it. And if it gets big enough, if there are enough people, then it turns into advertising, and then you have to do the filing requirements, what have you. But like I say, 25 or fewer in a 30-day period, retail investors, and different rules for institutional investors. That's going to be correspondence. All right, so we also have the Uniform Practice Code, which, again, we talked about that, governs the way that members practice among themselves in the industry. And so prompt delivery and receipt of securities is required. You remember way back when we talked about the settlement date, and we said that member to member, firm to firm, on the settlement date, money will go this way and stuff will go that way. Now, the folks, Reg T gives them 2 extra days. But member to member, it's going to happen because it's in the Uniform Practice Code. That's what they just have to do. They don't have any choice. All right. The restricted persons for equity new issues. If you're employed by a member firm, you're restricted from participating in new equity IPOs. But I'm just a landscaper, you know. I mean, I'm employed by this broker-dealer firm, but all I do is just plant the flowers and take care of stuff like that. That's okay. It doesn't matter. If in the upper left-hand corner of your paycheck it has a member firm's name, you're restricted. And so is your family. Your immediate family, anyway. Well, what's immediate family? Let's see, your brothers, your sisters, your kiddos, your mom, your dad. What about Uncle Fred and Aunt Millie? Uncle Fred and Aunt Millie are okay. That's where immediate family stops. So all of the following except Uncle Fred and Aunt Millie are restricted. We have seen that's the oldest question in the book with regard to restricted persons on equity IPOs. So it's okay for Uncle Fred and Aunt Millie. There's also, I doubt that you see this, but there's a little de minimis exemption. If I'm in an investment club, let's say, and then I get in the business, and we've got we've got 250 members in the investment club. Well, my gosh, my percentage ownership in that is just that big. If it's less than 10%, it's no big deal. All right. But if it's like a family trust or something like that, no big deal if I have less than 10%. Trading in mutual fund shares is prohibited. That's what we're talking about rolling from fund family to fund family. You're hitting your customer with a sales charge every time. It's going to generate excess sales charges, and then comparable funds in the same family should be used at the member level. Okay, that's at the retail level or customer level. At the retail level, what can a broker-dealer firm that's a member, what can they do? Well, remember we had up here where we took from the person back to the fund and then took it back the other way so we could demonstrate discounts. What has to happen is that the broker-dealer has to buy those shares in order to fill that customer order. That's what we do. So that's definitely allowed. The member firm also makes investments of its own money. Can it invest as a long-term investment in mutual funds? Absolutely, no problem at all. But can it buy in anticipation of customer orders and hold those in a trading inventory like it does Microsoft shares? No, no. And here's the reason why. Okay, is that if you remember we have breakpoints on these things, and once you reach a certain point of the purchases, you get to a 0% sales charge. You buy it at NAV. Here's what would happen: is that the fund, okay, boom, to SPUD, to the broker-dealer, which buys a huge bucket of mutual fund shares. And then what they do, because it's so huge, they do it in NAV. And then what they do is that there's Bob, who puts in a minimum order. There's Sam, who puts in a minimum order. Sally, Sue, Mary, Jim, etc. Okay? And what are they doing? They're cheating the distributor. It's not okay to cheat. Okay? So they can't buy those for their own trading inventory. All right, let's see then, investment company shares. Let's see. Let's go ahead and go through a couple more of these bullet points and then we'll take a little break. But investment company shares, members must maintain the public offering price. What's the flip side of that? That no discounts can be offered except what's in the prospectus. So we've kind of gone upside down, backwards, and sideways on discounts. So customer breakpoints, rights of accumulation, letters of intent, those are all in the prospectus. Member-to-member discounts, that's all it's all allowed. It's what we do. But nothing beyond that. And then redemption cannot be higher than at the NAV. Now think about it, okay? On maintaining the public offering price, that's the front end. We can't give an unfair advantage on the front end when things are purchased. On redemptions no higher than the NAV, we can't give a bonus, a kickback, or a refund of sales charges on the back end. So we're talking the front side or the back side, they're both covered. All right, we just abide by the rules. Redemption cannot be higher than the NAV, and then member transmittal of funds. When does the member firm have to send money to the SPUD? Well, they've got to do that the ladder of trade date +3 or receipt of funds +1. So if the customer doesn't bring it in until the 4th day, then the member can transmit those funds on the 5th day. And then the broker-dealer surrenders the concession to the SPUD if the shares are redeemed within 7 business days of purchase. Now let's look at this one because you're very likely to see a question on this, okay? And we've got to go back to our old buddy, that flow chart that we had, okay? There's the fund, it gets NAV, there's the SPUD, there's the broker-dealer, and there's Bob, okay? What happens is that Bob pays public offering price, okay? Boom, the selling concession goes to the broker-dealer, boom, the underwriter's concession drops out, and boom, the fund gets NAV. Bob gets buyer's remorse. And so within 7 days of the transaction, Bob says, I just made a big, big mistake. I want to get out of this thing. Can I get my money back? Well, kinda, Bob. Kinda. But the thing is, the rules say that I can redeem this at no higher than the NAV. So what's going to happen to you when that money comes back across here, you're going to get the NAV. That's a possible question. It's within 7 business days. I think it's business days, let me check here, but, yeah, 7 business days, I never can keep that straight. But Bob still gets the NAV. But now what does happen, because of the fact, let's ask this, okay? That's the underwriter. Did the underwriter underwrite? Yeah, they did their job. The broker-dealer sold. Did that sale stick? No, it wasn't a good sale. Therefore, within 7 business days, if Bob says, nah, I don't think so, this goes over here. Okay? So, from one perspective, the selling concession is surrendered, but it's surrendered by the broker-dealer to the spud, because they did their job. The broker-dealer didn't make a good sale. Question number 2, how much money does Bob get? I'm sorry, Bob. You're going to get NAV. You give me a contract to purchase that at the public offering price when you say I want to buy it. And when you give me a sell order, you give me a contract that says I will take the NAV. Period. That's it. Sorry. It's the way life works. All right. So anyway, let's see. Then trading authorizations or disclosures. We talked about that earlier. Appropriate papers must be in hand, approved, on file. If not, it's an unauthorized transaction. All right. The papers are in the mail honest. Yeah, the check's in the mail honest too. I believe that. You know. But anyway, the gift limit of $100 per person per year. Again, we're talking about the Uniform Practice Code. So like the mutual fund company wants to give you a gift. That's why you get so many coffee cups. It's just nominal value, advertising, whatever. They're not going to get. In fact, they're starting to kind of cut back on the sleeves of golf balls, because how many sleeves of golf balls does it take to get to $100? You know, not too many anymore. So like I say, it's been been $100 for several years. And then continuing commissions. Let's go ahead and cover this, and then we'll take a break, pick it back up. But continuing commissions. Let's say that I want to retire. I can actually continue to receive commissions if there's a contract that's written out and approved by my principal, therefore by my firm. But the thing is, and here's the most likely question, it can cover only existing business. So basically I talk to you and I say, look, I'd really like to retire. Would you like to handle my book for me? And we'll just kind of phase me out and phase you in. And then you'll have a book, but I'll have some residual income. Sure, we write it out in a contract. You find a new customer, that customer is yours. Because I didn't have anything to do with it. And so therefore, it's like I say, it's existing business only. That's what we're restricted to. All right, so let's go ahead and break it off here. Then we'll come back, pick it up, and probably we'll be able to get the rest of the way finished in this next video. So we'll see you in a little bit.